Radian Group, ticker RDN, they just reported their second quarter 2026, and, well, they missed Wall Street's consensus on the bottom line by nearly 15%.
Yeah, it was quite a miss on the earnings side.
Right. Adjusted earnings per share came in at $1.14 against a $1.34 consensus. And GAAP EPS sat even lower at $0.87. But here's the crazy part.
The revenue.
Exactly. Total revenue absolutely crushed estimates. They hit $575 million versus the $557.15 million forecast.
Which is just a massive 93% jump year over year.
We're nearly doubling their revenue. And for full-year guidance, Radian Guarantee actually raised its dividend expectations to the holding company from $600 million up to at least $650 million. Plus, management noted that specialty earned premiums should jump about 20% in the second half of 2026.
Just due to seasonality. Right.
Right. But the market didn't care about the top line. They immediately punished the bottom line miss. Shares fell 7.22% in after-hours trading, dropping down to $36.34.
Though we did see some value-oriented buying the very next day.
We did, yeah. The stock rebounded about 1.79% to close at $36.91, which is hovering right near its Q2 book value of $36 per share.
You know, you have a company here that nearly doubled its top-line revenue in 12 months, yet still managed to fall short of earnings expectations.
It's a huge divergence.
Exactly. That kind of divergence always forces you to look under the hood, at the underlying mechanics.
Which is exactly our mission for this deep dive. For you listening, we are unpacking Radian's Q2 earnings call and their financial reports to figure out exactly how that massive revenue versus earnings disconnect happened.
Right, where's the money going?
Exactly. We're going to break down their recent multi-billion-dollar specialty insurance bet, look at the underlying mechanics of their legacy mortgage cash cow, and figure out what a major CEO transition means for your portfolio.
So to find the root cause of that top and bottom line divergence, you really have to look at the massive strategic shift Radian just executed.
The Inigo deal.
Yeah, the Inigo deal. This is their first full quarter consolidating the numbers from their $1.67 billion acquisition of that Lloyd's specialty insurer, Inigo.
Which fundamentally changed what kind of company they are.
Oh, absolutely. They essentially transformed overnight from, a leading U.S. mortgage insurer into a global multi-line specialty insurer.
And the sheer scale of that transformation, I mean, that is what drove that 93% revenue jump I mentioned at the top.
Right. The premiums tell the whole story on the top line here.
Yeah.
Net earned premiums climbed 116% year over year to $504 million.
Wow.
Yeah. And the new specialty segment accounted for $267 million of that. So roughly 53% of total net premiums earned.
So it essentially generated half of the company's total revenue for the quarter.
Half the revenue, exactly.
Okay, let's unpack this.
Yeah.
Because the bottom line for that same specialty division only produced $29 million of adjusted pre-tax operating income.
Right.
The revenue scale is massive, but the profit conversion seems, well, it seems terrible. It feels like they bolted a massive high-horsepower engine onto the car, right?
Yeah, sure.
Sure, the top speed of revenue doubled, but it's absolutely guzzling gas on the earnings side and ruining the efficiency. I mean, is this a classic case of diversification?
Well, what's fascinating here is that the transplant analogy, or the engine analogy, it works because the friction of the integration obscures the actual health of the underlying asset.
What do you mean by friction?
Well, the GAAP profit margins were heavily weighed down by purchase accounting adjustments. When Radian acquired Inigo for $1.67 billion, the accounting rules actually required them to book $39 million in amortization and acquisition-related expenses this quarter.
Oh, got it. So for you listening, it's really important to separate cash from accounting here.
Yeah.
That $39 million isn't actual cash leaving Radian's bank account today.
No, not at all. It is a purely non-cash charge. You see, when you buy a company at that scale, you acquire intangible assets.
Things like brand value or...
Yeah, brand value, client lists, or specialized underwriting models. And GAAP requires you to slowly depreciate the value of those intangibles on paper over time.
So that amortization directly suppresses the reported earnings per share.
Exactly. Even if the actual cash flow generated by Inigo's daily operations remains robust. In fact, if you look at adjusted earnings for the first half of the year, this segment actually contributed $0.36 per share.
Oh, wow.
Yeah, which drove a 12% year-over-year growth metric in first-half adjusted earnings.
Okay, I understand the accounting mechanics, but Wall Street isn't stupid. They know how to read past a non-cash amortization charge, yet they still dumped the stock 7% after hours.
True.
They must be seeing something beyond just paper friction that makes them nervous about this new segment's profitability, right?
Yeah, they are. The market's anxiety really stems from the elevated loss provisions Radian booked in the quarter. That directly constrained that $29 million pre-tax operating income figure.
Right.
To gauge the true health of this new division, you really have to look at the underwriting margins.
Which means looking at the combined ratio for the specialty segment. And for the quarter, they reported a combined ratio of 97.7%.
Yep, 98% basic.
Right. Now, just as a quick refresher, any ratio under 100% means they are technically making an underwriting profit. But a 98% combined ratio means they are paying out roughly 98 cents in claims and expenses for every single dollar they take in.
Right.
A 2-cent margin on the dollar leaves zero room for error.
Zero.
Yeah.
But a massive driver of that razor-thin margin was a specific $30 million reserve charge.
Okay, what was that for?
Management explicitly tied this reserve to ongoing developments in the Middle East. It's designed to cover both expected and potential claims arising from the conflict there.
Yeah.
But also, it addresses updated inflation assumptions across their entire insured portfolio due to all the macroeconomic uncertainty.
Wait, let's be clear on the mechanics of that reserve. Management isn't necessarily saying they have $30 million in immediate claims from the Middle East right now, are they?
No. They are adjusting their macro models. They are building a buffer.
Okay.
The conflict introduces geopolitical instability, right?
Right.
Which ripples into global supply chains and triggers macroeconomic uncertainty.
So they're factoring in potential inflationary pressures that could increase the cost of future claims across their whole book of business.
Exactly. And management noted that if you strip out that specific $30 million charge, the first half combined ratio for the specialty segment would actually be sitting in the high 80s.
Oh, which represents a much healthier underwriting margin.
Much healthier, yeah.
But, and this is a big, but even if we give them the benefit of the doubt and strip out that one-time charge, management also guided that the broader specialty market is actively softening, right?
Oh, it did.
Rates are coming down, competition is increasing, and going forward, they expect combined ratios to settle into the, quote, low 90s.
Yep.
So if you know the market is softening right after you spent almost $1.7 billion on an acquisition, aren't they essentially catching a falling knife in the P&C space? Like, you're walking into a high-stakes auction where the only way to win business is by underpricing the risk?
Well, in a soft market, insurers are suddenly the ones bidding against each other for the customer. And yes, the temptation is always to lower your underwriting standard just to keep the revenue flowing.
Right.
But CEO Rick Thornberry explicitly stated on the call that Radian is prioritizing margin over volume. They knew the market was softening when they modeled the Inigo acquisition.
But saying you prioritize margin over volume is really easy on an earnings call.
Sure.
Proving it is much harder when your shiny new segment starts showing revenue declines. Exactly how do they demonstrate that discipline mechanically?
By showing a willingness to actively shrink their new business pipeline if the rate adequacy isn't there.
Okay.
See, in a hard market, premiums are sky high, and insurers are rewarded simply for participating and grabbing market share. But in a soft cycle, the true test is having the discipline to walk away from bad risk.
So not chasing bad premiums.
Exactly.
Yeah.
Management stated they will not sacrifice pricing or terms just to maintain premium volume. If they can hold that line and navigate this soft cycle without loading their balance sheet with underpriced policies, well, it validates the strategic value of the Inigo underwriting team.
But shrinking your pipeline and refusing to chase volume means your new $1.67 billion acquisition won't be generating massive excess cash in the short term.
Right, it won't.
So if the specialty segment is navigating a soft cycle and tightening its belt, the money funding this entire enterprise has to be coming from somewhere else.
And it comes from the legacy mortgage segment.
It's a cash cow.
Exactly. While Wall Street was hyper-focused on all the friction in the new specialty division, the mortgage segment quietly generated $208 million in adjusted pre-tax operating income for the quarter.
Wow. Let's break down the metrics on that side of the house. Because new insurance written, or NIW, rose 14% year over year to $16.3 billion.
Yep.
And their primary insurance in force hit an all-time company record of $284 billion. That's up 3% from last year.
But more importantly, the combined ratio normalized to 35.8%.
Right, and that combined ratio is the metric that matters most here. It is up slightly from the 30.4% last year, but a combined ratio in the mid-30s is just incredibly strong.
Is.
It means for every dollar of premium they collect on the mortgage side, they are keeping roughly 64 cents as pure underwriting profit before taxes.
Exactly.
But I want to push on the credit trends, though. We are in a high interest rate environment. The macro narrative is that consumers are stretched,
Right.
Normally, you would expect defaults to be rising, which would eat into that 64-cent margin.
You would think so. But the data Radian reported actually counters that narrative. Their default rate dropped to just 2.47%.
Wait, dropped? How?
Mechanically, what happens is that cures, so situations where a delinquent borrower gets caught up on their missed payments, those cures actually exceeded the number of new defaults entering the system.
And that cure activity has a direct financial benefit beyond just lowering the default rate percentage, right?
Huge benefit. It actually resulted in a $20 million favorable development from prior period defaults.
Okay, explain that for the listener.
So when an insurer thinks a loan might go bad, they have to set aside cash reserves to cover the potential claim.
Right.
But when the borrower cures the delinquency and the loan becomes current again, the insurer gets to release those reserves back into their earnings. So loans they assumed would be losses turn back into performing assets.
Wow. Here's where it gets really interesting, and it brings up a fascinating structural dynamic in their portfolio. Radian reported an 82% persistency rate for their mortgage insurance policies.
The golden handcuffs.
Yes, the golden handcuffs. For you listening, think about your own neighborhood right now. Anyone sitting on a 3% or 4% mortgage is absolutely refusing to put a for sale sign in their yard.
Nobody is moving.
Nobody. Management noted that roughly half of their entire in-force portfolio carries underlying mortgage rates of 5.5% or lower.
Right.
How does that macroeconomic free mechanically benefit Radian's bottom line?
It fundamentally alters the duration of their cash flows. Think about it. In a normal, fluid housing market, homeowners sell, move, or refinance every 5 to 7 years.
Right.
And when a borrower refinances to get a better rate or sells the home, the old mortgage is paid off and Radian's insurance policy is canceled.
They lose the premium.
They lose that recurring premium stream and have to spend money to acquire a new policy to replace it.
The churn forces them to constantly hunt for new business just to tread water.
Exactly. But in the current environment, borrowers with sub 5.5% rates are simply paralyzed. They cannot afford to trade a 3% mortgage for a 7% mortgage, so they stay put.
Wow.
For Radian, this locks in steady, predictable premium revenue without the typical churn. The lack of refinancing activity turns their legacy mortgage book into a highly predictable, long-term, cash-generating fortress.
That makes total sense. I do want to note, though, management did flag a $1.15 per share headwind for mortgage provisions for losses in the first half of the year, so it isn't completely without friction.
Right, there is some normal provision building.
But the overarching reality is this segment is pumping out massive amounts of predictable cash, which forces us to ask the ultimate capital allocation question.
Right.
If the legacy mortgage business is throwing off hundreds of millions in cash while the new specialty business is trying to navigate a soft market, what is management actually doing with all that liquidity?
Well, their capital allocation strategy is highly aggressive, and it's heavily focused on returning cash to shareholders. Radian Guarantee, the mortgage subsidiary, they paid a $200 million ordinary dividend up to the holding company in Q2 alone.
Wow.
Yeah, that brings their total upstream dividends to $340 million for the first half of the year. And they raised their full-year target from $600 million to at least $650 million.
And what does the holding company do with that cash once it receives it?
They distribute it directly to the retail investor. Radian Group paid a $37 million dividend to stockholders in the quarter, which represents a 2.6% yield.
And I think they noted that's their 6th consecutive year of dividend hikes.
It is, yeah. But the more aggressive lever they're pulling is on the share repurchase side.
Okay, let's hear the buyback numbers.
They bought back 2.2 million shares for $76 million in Q2. And then in July, they bought another 1.3 million shares for $50 million.
So they are moving fast.
Very fast. Management noted they are tracking toward the upper end of their $200 million to $250 million full-year buyback target.
So what does this all mean for the retail investor? I want to dig into the mechanics of those buybacks because buying back stock isn't always the best use of capital.
Right.
Why aggressively repurchase shares instead of issuing a massive special dividend to investors? Is this a signal that management thinks the market is drastically mispricing their new dual-engine business
Oh,
model?
without a doubt, you have to look at the valuation. Radian is currently trading with a price-to-book ratio of 1.01.
Okay.
That means the stock market is valuing the entire company at almost exactly its accounting liquidation value, which is $36 per share.
Yeah.
Yet, Radian is generating a 13% adjusted return on equity.
Wait, if a company generates a 13% return on equity but trades right at its liquidation value, the market is essentially saying they don't believe those returns are sustainable over the long term.
Exactly. The market is doubting them. But management clearly disagrees. When your stock is trading right at book value, every single dollar you spend buying back and retiring shares mechanically increases the future earnings per share for the remaining shareholders.
Because you are dividing the same profit pool by a significantly smaller number of shares.
Precisely. In fact, the share count reduction from these buybacks already added $0.09 to their first half EPS.
So it props up the per share metrics while they wait for the market to actually understand the Inigo acquisition.
Yep. And they're also actively cleaning up the balance sheet to fund this.
Right, didn't they pay down some debt?
Yeah, they repaid $125 million of a $200 million revolver draw, bringing their leverage ratio down to 19.2%. Holding company liquidity sits at a very healthy $412 million.
That's a lot of dry powder.
It is. And they are systematically shedding non-core assets to simplify the narrative. They finalized the sale of their real estate services business and agreed to sell their title business.
Right. And this massive simplification effort is all happening against the backdrop of a major leadership transition, too.
Right. CEO Rick Thornberry is retiring.
Yeah, he's handing the reins over to CEO-elect Mike Weinbach. Weinbach noted on the call that entering 2027, the company will have effectively doubled its revenues and vastly simplified its focus.
It's a huge shift.
It is. They want to shed the legacy label of just being a mortgage insurer and force Wall Street to re-rate them with the valuation multiple of a diversified global multi-line insurer.
And the divestitures of the real estate and title services, that's a clear signal to the market. They're stripping away the distraction to highlight this new dual-engine model. You've got a cash-printing mortgage fortress on one side and a high-revenue global specialty insurer on the other.
But the reality is Wall Street is still trying to figure out how to value this hybrid model. The 7% drop after earnings proves the market is highly skeptical of the friction involved in combining these two completely different beasts.
It really does. Which leaves us with the most critical question for any investor looking at Radian over a long time horizon.
Okay, what's that?
Radian's entire transition strategy relies on a delicate balance between two completely different economic cycles. Right now, the mortgage segment is a cash fortress, largely because of the golden handcuff effect we discussed, where homeowners are locked into those sub 5.5% rates.
Right, the paralysis in the housing market is their greatest asset right now.
But what happens in 2027 or 2028 if macroeconomic shifts cause those handcuffs to break? If inflation cools and interest rates drop significantly, the paralysis ends. Homeowners will flood the market to sell or refinance.
Which means all those highly profitable, long-duration mortgage insurance policies suddenly get canceled, and Radian loses that massive, predictable premium stream. They would have to start spending aggressively to acquire new policies just to replace the runoff.
Exactly. Now, combine that potential mortgage cliff with the other half of their business. Management already guided that the specialty property and casualty market is actively softening.
Right, the low 90s combined ratios.
Right. So what happens if the mortgage lock-in breaks, causing a sudden drop in legacy premiums at the exact moment the specialty insurance cycle hits peak softness and those combined margins compress even further?
Wow. That is the ultimate stress test. Can their capital allocation strategy, their balance sheet liquidity, and their underwriting discipline buffer a hit to both engines simultaneously if those two distinct economic cycles happen to bottom out at the exact same time?
It is the defining question for the new leadership team. I mean, they have built a much larger, more globally diversified machine. The next few years will determine if the chassis is strong enough to handle a dual-cycle downturn.
We will certainly be watching those combined ratios closely to find out. For you listening, make sure you follow the show for your daily no-fluff earnings coverage. We'll catch you on the next deep dive.